Good morning, class. Uh, this is financial accounting lecture. We are still in chapter 1 of this course, and this is our lecture 4. Now, this chapter, we are going to look at the basis of accounting. On that basis of accounting, we are going to look at the 3 bases of accounting which go to the heart of how transactions are recognized and measured in an entity. And these 3 basic bases of accounting are: 1, have accrual basis. Number 2, we have a cash basis. Number 3, we have a break-up basis. So these are the 3 bases of accounting we shall look at. Let's start with accrual basis. This accrual basis is accrual accounting, accrual concepts. This is a concept whereby transactions are recognized and other events and circumstances in the period in which those transactions occur, even if the resulting cash receipts and payments occur in a different period. And this accrual basis now saying that we are to recognize either income or expenses that it actually happened in that period, whether the cash has been received or paid in a different period. Then the accrual basis is of the opinion that we are to recognize it in the period in which it happened. For instance, let's assume that you now make sales of sales of 50,000 in January 2022. So this sales now meets all the requirement of revenue according to IFRS 15. You are now expected to recognize this revenue in January 2022. But this your sales, you have not received this 50,000 naira in January. You only receive it in February 2022. So what this accrual basis is saying is you have to recognize this 50,000 naira as revenue in January, not in February, where you receive the cash. You have to recognize it in January. That is where the transaction actually took place, and all the costs, expenses that relate to this sales, you are also to recognize them in January 2022, not in the February 2022. That is what this accrual basis or concept is all about. And the next one is, let's look at another example here. Say a company prepare its financial statement to 31st December each year, that is 31st December. each year. He sells goods of 50,000 naira to a customer. That is, this is where you prepare a financial statement, FS. Then now sells goods of 50,000 naira, 50,000 naira to a customer on 6th of December. This sales now took place on 6th of December, year 2, but does not receive a cash payment from the customer until 15th of January, year 3. Cash received the 15th January, year 3. So how are you going to record these transactions? If you look at it, the sales took place on 6th of December, year 2, and you prepare your financial statement 31st December each year. So now, which year are you now going to recognize this your transaction? Because you received the cash year 3, January 15th. So what this basis is saying, concept is, you have to recognize your sales of this 50,000 naira in year 2, not in year 3, because the transaction took place in year 2. You just received the cash in year 3, so you are only allowed to recognize this your sales in year 2. This what this basis is now saying. Under this accrual basis, we can still talk about prepayments and accruals. Say accruals and prepayments. The accruals and prepayments. An accruals or accrued expenses is an amount that an entity owes in respect of a benefit it has received in a period, but for which it has not yet been invoiced. An accrual is an estimate of both of the benefits received. This accrual is whereby you now received a benefit. Let's say you enjoy a service in year 1, but you have not invoiced, you have not paid for that services in year 1. What are you supposed to do? You have to now make provisions. Let's say year 1, you enjoy service of 50,000 naira. Year 3, now made the payments of this 50,000 naira. In which period are you expected to recognize this your expenses of 50,000 naira? You are expected to recognize it in your year 2, because you enjoy the services in year 2. All this service of 50,000 naira, you receive it in year 2, so you have to make provision for it in year 2. When you make the actual payment in year 3, you can now reverse your provision. This is what this is saying. Then we are now going to look at the prepayments. This prepayment is an amount of money paid in advance for benefit that will be received in the next accounting period, whereby you have not enjoyed that service, but you paid in advance. You have to now treat this like, for instance, you rented a prepayment in year 1. Let's assume that you have an expenses that you incur in year 1. Let's keep our 50,000 naira in year 1, but these expenses for 50,000 naira, the vendor or supplier or contractor has not rendered the services, you are now to enjoy this service in year 2 of this 50,000 naira. What are you supposed to do? This process, you are now expected to treat this as prepayments. You made the payment, but you have not enjoyed it. And under your financial statement, it's going as current assets. That is how to treat this prepayment, and that is all about this prepayment. Then the next thing is let's go to our cash basis. Is cash basis. What is cash basis? Under cash basis, accounting recognize transactions in the period in which cash receipts and payments occur, and this revenue from sales and other income will be reported in the periods when the cash is received, which might be in a later period than when the income arose. What this means is all the transactions, let's assume transaction took place in year 1, but you have not received the cash till year 2. You are not expected to record your transactions in the period in which you receive that cash, or in the period in which you made that payment. That is a cash basis. Let's still keep our example, the one we use in the accrued basis. Under that, you see that we said sells a good of 50,000 naira. I think that is it. You said 50,000 naira. In that 50,000 naira, on was 6th of December, year 2. But we do not receive that payment until when 15th of December. Yeah, this is year 2. Payment year 3. So now let's assume that, and the FS is counting period is 31st December each year. So when are you going to record this transaction? Under cash basis, we are to record it in year 3, not in year 2. This is what this cash basis is all about. Then we have a break-up basis. Break-up basis. The break-up basis is a business. It's a situation whereby the business is going to wind up, and there is either financial difficulty, or the business, in short, is not on going concern basis. So what will now happen? Both the accruals basis and the cash basis assume that a business is a going concern basis. That means that the business is expected to continue into the future, but under this break-up basis, the business might be brought to an end. That is either due to financial difficulties, or the owners of that business decide that the business has run its course. They just decide to end that business. And the basis results in all the asset and liability being measured at the amount of cash that they can be sold. That is for assets, or settle in the case of liability. That is the break-up basis. Now let's look at example under this break-up basis. A company prepares its financial statement to 31st December each year. Is, let's say, FS 31st December each year. The company is in the financial difficulty and is not expected to survive. It has a building in its account carried out. It's a building. The book value of that book is what? 1,500,000. This is the carrying amount of that building. The real estate professionals have advised that this building could be sold for only 1,200,000. 1,200,000 in the current market conditions. That is the value the estate professionals advise that we can recover from this building instead of 1,500,000. The building should be remeasured up to 1,200,000 in the financial statement. Instead of carrying that building as 1.5, then this breakup basis saying we are to recognize this building in our books as 1,200,000. This what this basis is now saying. Okay, thank you so much for your time, and in our next video we are going to look at the need for financial statement. Under that, we are going to discuss the users of a financial statement. Thank you so much.